let's now revisit all the execution patterns that we talked about and look a little bit more in depth to them, and obviously cover them once again. Why they happen, where you want to be looking at them, and what sort of confluence you will be bringing to from the order flow and auction market theory perspective, and also how you should be then proceeding to managing those trades you take. So the first one is a failed swing, and obviously the characteristic of a failed swing, it's a mean reversion trade. You are this is kind of a self-explanatory basically, but there is a sort of a mean reversion to it. You have any sort of balance in a ranging environment, and you are just kind of trading back inside any sort of mean. So this is a mean reversion trade. Like I said previously, there is no hidden hand in the market. No one is manipulating the market. There are no market makers running people's stop losses. This is simple a kind of a supply and demand characteristic. Market is going to reach a previous level of support and resistance, and it will both trigger the stop losses of people who previously traded there, but also it will bring out the breakout traders that will start smashing the bids and the offers on a higher volume, which makes a great level for anyone trading with any sort of size to absorb these buyings and sellings. So this is just how market works. This is not something hidden secret. What is the key thing about this is that fading at key levels is crucial. You will see very often that these kind of a failed swings, where especially those that market will leave the wick, they will happen often, but this doesn't matter that you should be trading all of them basically. That's, you have a small failure here, for example, you have this candle that failed here. Like I said, they will happen often. The lot of candles will trade under or above the prior candle swing point and then just close on the other side. Like I said, it doesn't mean you should be trading all of them. The picking the key ones is your kind of a way to do it. And what are these key reference points? The prior day and week highs and lows. Obviously, these can be prior month and prior year highs and lows. It depends on the way you are going to be trading. What is important here is that these levels should be fresh. If you have, for example, if you have prior week high, which is left there from let's say Thursday, and the market sold off from it on Monday, you're gonna come back to that. You're gonna put this failed swing, which you then can be trading. But if market then decides to come back again, this is not a fresh level. This was a good to short here. Now not so much. This all the way comes back to the things that I mentioned about the supply and demand, getting consumed by more and more touches at the level. So on the second touch, you either want to see the next failed swing from the previous high, which would then create a 3 drive and another failure, or you can just kind of stay away from the trade. I think if you are going to take it into the triple tap, that's completely fine, but like on a fourth touch, I would be just waiting and anticipating a breakout and then possibly trading a continuation. Daily, weekly, monthly swing points, obviously these are the swing highs and swing lows on a higher time frames. These will always be important because they will bring a higher time frame participants to the market. That's kind of a this hitting these levels will very often give you a bigger reactions. Once again, you wanna trade these levels when they are fresh. If you have a monthly swing high and market is about to test it for the 5th time, you don't want to be trading there. Technical pattern failures, this is something that I haven't talked about yet, but it's quite self-explanatory. It's you will have a lot of these technical patterns, which obviously are um, head and shoulders. They are, double tops, double bottoms, triple tops, triple bottoms, all these kind of wedges and stuff like that. So for example, if we are going to take a look at very simple example is that you have a clean double top in the market. All the kind of a newer, unexperienced traders are shorting this, which makes it perfect level for not only targeting the trades from below, but also if market is about to fail there, you can also short that. What you will often see, I will show you the example on a chart in a second, are these kind of wedges, where market is looking something like this. Everyone is anticipating the breakout to the upside. The breakout is going to happen, but then you will just take this kind of a highest high and fail from there. This happened quite recently on Bitcoin. If you take a look at the daily chart of BTC, excuse all the levels here, but we are looking at this kind of situation. You have this kind of a wedge or triangle. Below it you are putting up a clean kind of a double bottom. Market then proceeds to break it. Everyone is thinking this is the low is made, but we are just clean out this high on this daily candle and absolutely plummet from there. So these are kind of your technical patterns that you should be aware of, because they will bring a lot of attention to a lot of people, and usually more often than not they are going to fail. The poor highs and poor lows are the last key kind of reference point which I'm looking at. This is going to be more relevant for people who are trading intraday or kind of a shorter term intra-week, but these equal TPOs from a same day on a market profile are extremely easy to spot, because all the platforms will highlight them automatically. So these are once again good level for fading. What is kind of a interesting if you are intraday trading, and this happened to me plenty of times, where I didn't pay kind of enough attention, is that you have a value area from a day, basically, looking something like this, and you have a kind of a poor low below it. Market, starts to trading on the next day. Market is looking something like this. You will open on the next day, market will move lower, and you will have, for example, another low here on a prior day value area low, and you will see some sort of failure, and you will start jumping into the longs, because we took some swing low here, or it can be some sort of cluster resting here as well. It doesn't really matter. You basically have a reason to get long at the prior value area high to play the rotational bias, or just going for a new highs. It doesn't matter, but you won't pay attention to this poor low below you, so market will just make a small bounce, then flush the lows and then reverse. So if you have such any kind of a poor structure, and this comes back to the compression I talked about, which if you have any sort of unfinished business below or above you, it's much better to just wait for market to solve this. Sometimes it will result in you completely missing the trade, but it is what it is, because there is this kind of a possibility, and this is kind of a thing that obviously if you decide to take a trade here, the market will flush lower. If you decide to skip it, market will just continue higher. But from sort of my experience and from what I've seen in different markets, it's always better if you are in close proximity to any kind of level which can be traded. It's just better to wait. Okay. This is a chart of a euro from a couple of weeks back, and you can see this. This was really a kind of a ranging market. Market just was bouncing back and forth, and there is a new week which started right here. Okay, so this separates two trading weeks, and this is a prior week low, and this is the prior week high. And as you can see, the best kind of a reaction you gonna get is once you take those highs and lows. This is the example which is harder because obviously this one is pretty clean. You will come down on a high volumes, and you will leave the wick. This is where you have kind of a room to, you just kind of get long, put your stop below the low, and you'll go there. This one is complicated because the candle will actually close throughout the level. So for this one, you want to see this first kind of rejection to the downside. But this wasn't easy trade because, as you can see, we didn't really sell off. We came back lower, which then kind of looked like we might going to hold this structure down below. But only thing that we actually did is started this slow compression to the upside, tested this high volume candle, which often happens. This is also your kind of a volume cluster, although it didn't completely break the structure. There is a high volume executed in this candle, and you will often see that these high volume candles will act as support and resistance. So once this got tested, we completely flushed lower. And there are also a lot of kind of a failed swings inside this range, but not all of them are worth to trade. That's one of the kind of important things, because obviously you see something like this, which I don't think it's even completely took the high, but you might be considering going short here, which obviously in this case would kind of play out pretty well. But what is much better for me is to just waiting for a key weekly level to get taken, and then target this double top as your target for the trade. Okay. Another kind of thing you can see, you have a cluster here with naked point of control. Although price bounced a little bit from it, once again you can see the thing that I mentioned previously, this sort of a compression. This is kind of a unfinished level here. So and as we kind of keep bouncing before it, I wouldn't really consider trading this. I would just kind of wait if we see a failure here. So this is the example on a euro that I wanted to show. Another one, this is obviously the order flow confluence. This is very straightforward. I showed you this many times. What you want to see on a footprint, you want to see the buying. If you are going short, this is this candle right here. You want to see buying happening inside a wick. The point of control is also kind of it's here. I don't think you can see it properly. It's right here. The point of control sitting at the high of the wick. You have a candle with a huge buying delta. You can see the delta for a day here. It doubled in one candle. Okay, it went from 500 to over 1,000. So this is a huge amount of buying. Point of control is sitting above, but the candle will close below. This is your kind of a best one to do, and it is nice because even if you miss that, then you can use the candle as a cluster, where we kind of came back on a high volume, retested it, and make one more low. So this is your order flow confluence. Like I mentioned, don't try to kind of project things that are not happening. Only look at trades with have this kind of confluence on the footprint. Obviously this is also, as you can see it here, this was a prior week high from here, I think, at least, but let's assume it was. So if we are going to take a key level like this with this amount of confluence on the footprint, this is awesome shorting opportunity. If this wouldn't be key level, this would be just kind of a double top here, and your candle would be any sort of like, there wouldn't be this kind of absorption at the top. You wouldn't really have any sort of buying coming into the level. It's okay to just skip a trade. If you miss the failed swing, if you are not going to execute, you still have this opportunity that market will break kind of a level of structure that it made on the way up, and you can trade the retest basically. So executing the trade. there are two ways to get into market when you see a failed swing. The one is more of a conservative. This is a once if you have a candle with a wick, you will enter once that candle is closed. It's, for me, this is a 30-minute chart or 5-minute chart, or whatever time frame you are trading. If you have scenario like this where market if you have scenario like this where market will close through the level, and it looks like it might even continue higher, you want to wait for the second candle to close, basically. Ideally, you want to see this is not the case because this closed above the wick of this candle, but if it's a bearish or bullish engulfing candle, it's a good sign for going short. But for this case, I would just get in after this bar would close. Once again, you might have a opportunity to short again if you would not be sure here on retest of this high volume bar. Then you're gonna get a QM pattern right after that. So you can see how this was really a kind market, because it gave you more than enough opportunities to play this extremely obvious compression to the downside. Okay, so that's one of those things. It's not going to be always like this, but sometimes you can see how these kind of patterns layer up. Your stop loss. The stop loss is few ticks below the low. Oh, sorry, I didn't mention the aggressive way to take a trade. This is, let me actually show you this in a second on ExoCharts, because this is something that happened yesterday on Bitcoin, so we have a good kind of reference point for that. Just 1 second until this opens, but I will be talking basically about this case on BTC where market traded above this swing high on a daily. And as you can see, if I take a look on a 30-minute chart, which is 1 second, is this one. Okay, the market, this is the daily level of resistance, the daily swing high, and you can see the market only sold off a little bit before making a kind of a new high, and then sold off that. There is another level of a daily SR which we now selling on from, but this was a key reference point, and you can see that if you would wait for the candle close, that's a not the worst way to do it. But you can see, for example, there was no pickup on volume whatsoever. This was a failure candle, but where are those buyers chasing into the level? And if I'm gonna take a look at ExoCharts here, this is the case. Okay, obviously you can see that you have a lot of buying here. On a 30-minute footprint though, okay, there are some buyers, but this is nothing too insane. You have a 19 million delta on 70 million volume. When we were going up, you have 116 million volume on 17 million delta. You have 191 on 32 million delta. So you can say that, and even if you compare these delta candles, this is nothing too insane. This is not a blow off top. Look how this high happened. The volume here on ExoCharts is much. This is that significant kind of a blow off on volume. This not so much, but still, if you are trading intraday, and this is the candle where the high got actually taken, and you can scalp these things. From this is where it's extremely important to see the difference between the time frames you are trading, because although it's not a opportunity for me to play it as kind of a swing on 30-minute chart, if I watch these markets on intraday rotations, there is a trade there. This was the high. It was actually, I think, around here. Okay, let's see somewhere here. We test the level for the first time, nothing too suspicious, but then once we going to test it for the second time, look at this single bar delta. You have a lot of buying inside this small rotation, and market then pulls down from there. So although 30-minute footprint is nothing too insane, if I'm going to take a look at this 987 tick chart, the relativity of a volumes in this intraday time frame is much more significant, and you have this clean buyers, stuck at the top. We have a pickup on buying on a filtered footprint, and you have also this string of zeros, which, as I said, is signal of stops getting taken. So like I mentioned, on a 30-minute chart, this might not be the best opportunity, but if you will decide to just play any sort of a short rotation inside, for example, the daily value area high, this is more than fine, the trade that you take, because you are shorting here, and this market is starting to selling off, you will be actively trailing your stop loss. So even if you're gonna get taken out later on, you are really getting involved at kind of a top of things on a order flow confirmation. So this is extremely important, that you need to know the trades, the time frames that are trading, and have any sort of kind of expectations from how long you are going to be holding the trade. Also, one last thing that I didn't mention, this thing happened after a quite a big trend day, so if you are taking short here, the possibility that this will kind of a retrace all the way down until the end of the day is really low. So this is one of the things that I mentioned, during the trend days. It's, fading them is you need to have a really kind of a lower expectations, especially coming into end of the trading session when volatility dies down. And you can see that we pull back a little bit, but then this happened, this huge stop run on a buy bid, and market essentially held it and made a new high before selling off. Taking profits, you will be targeting the next level of potential reversal on time frames where trade is executed. We will discuss this a little bit later on, when I will be basically showing you the trading plans you should be having. But if you are taking a trade on 30-minute chart, this example of euro, basically, there is this clean double top here. There is a sort of a level of resistance up here, but from a weekly, if you are fading a weekly low, this is a significant level on a intra-week chart. You can see that I have this yellow level marker, which is basically a resistance, so I will be running the trade inside the next point of resistance, because obviously although it exceeded, you don't know that market can just go here, fail again, and then continue selling off into this cluster, which ended up not holding at all. But you need to pay attention to things such as evolving R, which I will be talk in a bit, and overall you will be just trailing your stop loss and targeting the next level where market can go against you, which will be the thing with all trades you will be basically taking, and it has to be relevant on a time frame you are trading. So like I said, if you take a trade on a tick chart, your next level should be based on tick chart as well, at least if you don't have any sort of higher time frame bias. Obviously the daily level of SR which got hit on Bitcoin is significant level. Like I said, trend day going into the end of the session, it makes much more sense to just take a scalp there, rather than hoping you caught up the absolute top of a kind of a short-term rally. So the take profits always be done and based on a time frame you will be taking a trade. And although this can sound a little bit confusing, once you start to using these different time frames, it will get much more easier to understand. Also, I have some kind of rules for the trades that I take, which I will show you later on, that you will be able to filter out these things. The stop loss is the few ticks below the low. You are basically betting on a high momentum move in and out of the level. There is no reason for market to hang out there for too long. These are those trades where you want to see kind of a immediate reaction. Obviously immediate reaction is once again dependent on a time frame you are trading, but this is the ideal scenario. Market swings to the level, swings out. Market here kind of a drifts to the level, but then puts this rejection and swings out. If you will see, I don't see anything where it actually failed, something like this. Okay, you take out this level of resistance here, market sells off a little bit, but then it picks up the pace again, so you don't want to be hanging in trades like this. Overall, this is the after any little bit of a reversal anyway, so your stop can be quite tight if you using this aggressive approach, which is kind of a immediate selling off once you get this first level of confluence or the reclaim of a level on a lower time frame. I didn't cover this, so let me actually show you what I mean. So you have a level of support and market bounce from there on a daily time frame. If market gonna come again there and start pulling back, this kind of a failed swing is not confirmed basically until the daily level is closed, which can take time, and if the daily candle closes somewhere above here, your risk to reward is pretty wide. So what you can do, and this is what I do very often, is that market is going to come into the level for the second time and you are watching basically a 30-minute time frame, and once you start to closing above it, or make any sort of QM, for example, like this, you are just going to take a long, but you are playing the daily level in this case, so you can run a trade little. Also, the most aggressive way was, which I showed you on a tick chart, where you will just kind of entering after the first candle closed on a order flow confluence. So you can see there are a little bit few more ways. If you are newer to this, stuck to this conservative one, wait for either a candle to close, which will confirm the failure, or if you close through it on a high volume, wait if you are not going to fail at the level for the second time. That's the kind of a easiest way to do things.